Hello, hello. So Intel reported earnings and things are looking horrid for the company. The earnings were pretty horrible and the stock is actually down about 10% in the after hours market, going retracing pretty much to 27 bucks. Now, if you take a look at the chart that we're having here, this is a 1 month chart. The company stock price back in December 28, as you'll see, was actually less than what it is right now after hours. So there may be an opportunity to buy again as the stock drops. However, we want to examine what happened because it may actually reiterate our potential decision on maybe buying the stock or potentially thinking about buying it. It is a company that I wanted to add to my portfolio and I may still think about it. I have to see what is happening. Of course, this is what we're going to be examining in this video. But there are some things that are positive about this company and some things that are negative. But before we discuss them, let's take a look at what happened here. So the shares of Intel dropped on weak quarterly results and expectations for another quarter of losses. So the guidance is also horrible, which is one of the core reasons why the stock is actually down 10%. It's not only that the fact that the numbers for this quarter were bad. And as you'll see, they failed to meet estimates for the fourth quarter because of steeper than expected fall off in PC chip sales, and guidance was soft as hell, you should probably say here, and the company's revenue declined for a fourth period. So that's a fourth period in a row as the PC market resides after expanding in the COVID pandemic, where things were pretty fine for a while, especially when the helicopter money was afoot. There was the stimulus. So Intel shares slid as much as 10% as it is right now in extended trading. That's pretty much after hours. And this is what happened. 10 cents per share is what they reported. That's adjusted versus 20 that was expected. So this is a pretty steep miss here. It's about 50% down from what was expected by analysts. And in terms of revenue, though, they also did worse than expected. Not that much, though, at least when compared to the earnings. But still, they did 14.04 versus 14.45 as expected by analysts here. And Intel's revenue declined 32% year over year. That's compared to the previous year's quarter that ended December 31. And it's the fourth consecutive quarter of falling sales. And this is a pretty bad sign for the company, of course. Four quarters of misses, not great. I mean, this is getting to a year right now. And of course, you can have a few quarters, maybe even a year. Normally, it doesn't really happen for such an extended period of time unless there is something out of the ordinary. And there was something out of the ordinary that happened. There was a COVID boom, as you would say. Again, the stimulus boom, I should say. But then, the whole market has been pretty much in the decline right now because of the crashing stock markets and economy right now. And so it makes a ton of sense that a company like Intel would fall for a while in terms of its earnings. It could be an opportunity, but let's take a little bit of a closer look here. Now, investors can expect more pain in the first quarter. So this is important because if we are looking to buy here, there could be some expectation for the stock dropping at least till we reach that quarter because not too many things are probably going to be happening in between. More than likely. I'm assuming that some investors will start accumulating a little bit, but overall, this may go up a little bit here and there, but I don't anticipate that it would fly in the first quarter. Of course, you never really know. But we do expect that maybe we can have a little bit of pain because Intel called for adjusted net loss of 15 cents per share on 10.5 billion. To 11.5 billion in revenue, and analysts actually were expecting 24 cents a share. So that's a huge difference here, and a 13.93 billion in revenue. So the thing is, now that guidance is out, pretty much this is horrible here. They're expecting a loss of 15 cents. So what could happen next quarter is that, for instance, they lose 5 cents or they lose 3 cents and basically beat on their guidance and the stock still goes up. So this is important to know here and realize because when you have low expectations, you could see a stock flying in the next quarter. This happens a lot, and even though the stock and the company is not doing great, because of the expectations, because of what is expected, and because they beat on these expectations, the stock could still go up, and especially if they have if their quarters start going back to normal, this could even fly potentially. Now, they did decline also to provide a full year forecast because of the uncertainty in the current environment. We do expect that this year is probably going to be weird for the markets and potentially, yeah, of course, for Intel as well. And pretty much the article here breaks down all the segments and what happened here with Intel. And the thing to basically remember and see from from this article is the fact that, and the earnings pretty much, the fact that the earnings reported from Intel were again kind of horrible, and they could potentially give us a nice entry point, but also there is extended risk now, because there have been quite a few quarters where the stock hasn't been doing great, and so for somebody who is entering here, you kind of have to be a little bit wary and consider the risk, and realize that the stock could be down for a while. Now, in terms of the long term, I think that the company will be a winner again. I don't think that they will be on the decline for many years, but it could take a while. I wouldn't be surprised if it takes like a couple of years or 2 or 3 years or so for the company to go back to its feet. That wouldn't surprise me at all. But let's take a look at what exactly has been going on with the company. Like, again, this is probably going to be around $27. And if you take a look at the 5-year chart over here, it kind of tells you the story of a company that has been on the decline for a long while now. It had a little bit of a bump over here. This is what the technical people would call like a head and shoulders, I believe. But you will see that, yeah, it went down, then people started buying a little bit, and then went down, people started buying a little bit. Kind of what happens when you have steep declines. But again, we are overall on a phase where the stock is actually going down and could keep going down for a while. And again, in the last 5 years, it's actually the lowest by far that you have seen it in these 5 years, not even close to the previous 5 years. And you can kind of see the whole story of Intel here being at a spot that is sort of like the midway in most of its years, sort of like the average that you have seen it in most of its years of its lifetime, I guess from 1998 or so, and after that. But yeah, you can kind of see here that this could be a potentially interesting opportunity after this insane decline. Now, the P ratio of the company right now, it's at 9, and it's going to be lower. So when the market opens tomorrow, this may be 8 or something, because the stock is down like 10%, maybe 8.5, something of that sort. The price to free cash flow is 12.9 because the company has been spending a ton in capital expenditures. Is something that we know about Intel. And they have been buying back shares, which also makes a ton of sense, especially since the stock is going down. It makes a ton of sense for the company to take a moment and actually buy the stock right now, as it's on the decline and it's going to be cheaper. Now, the company does have some liabilities here compared to its free cash flow, but it's not extensive, so 5.5 years of free cash flow to pretty much pay back all their total liabilities. But remember, they are spending a ton of their operating cash flow in capital expenditures, so that's kind of to be expected. It's not the fact that the company has a lot of debt; they don't really have that much debt, and it is a behemoth. It's a huge company that doesn't really grow much yet. As you can see here, their growth has been stalling, but it's a massive company. It's not like AMD. This company is making like 80 billion in revenue. It's a much larger company than AMD, for example, which is still growing a ton. So you can't expect this one to grow at an insane pace through the years. Now, the margins of the company have been on the decline as well, to be expected, and also right now having a loss. This is not great, but overall it looks like they can, for the most part, do something like 20%. Is probably what we would want to use for our discounted cash flow model. An interesting point here, the dividend yield has been increasing, of course, understandably, as you can understand, because the stock price has been going down and will increase a little bit more tomorrow, about 10% that is. So this is probably going to be like 5.2%, something of that sort, which is very interesting, very interesting. Now, the free cash flow payout ratio is 62%. The payout ratio, when you compare it to net income, is 45%. Obviously, this is higher again because of capital expenditures, but we do know that capital expenditures can be adjusted and will more than likely be adjusted in the future, because the company is actually spending a ton right now. They are investing in themselves, and it's a well-known thing. We have talked about it in the past as well. And so you can expect this to be maybe something near 45 to 50%, when all of the capital expenditures are accounted for. But you need to take this into account. Now, if we take a look at the dividends tab here, you can kind of see the history of dividends for Intel. And this is something that is actually scaring me a little bit because the company hasn't cut down on dividends yet. And I am scared that they may have to. Like right now, they are paying like 5%. I wouldn't be surprised if they eventually cut down on the dividends and maybe cut it down to 2.5% or something of that sort, like cut it down in half. And when that happens, a lot of people are going to sell and the stock is going to be on the decline for a while. That's what happens when companies are actually pretty much cutting down on dividends. So this is what would be scaring me, not so much the company itself and the financials themselves, which are also not great, of course, but the fact that the company could cut down on dividends is a little scary here, and you have to have that in mind if you are potentially thinking of buying this company. So this is scaring me a little bit. Now, will they do that? If we take a look at the financial statements, we can kind of potentially see what that means. And the way to see that is you can kind of see the capital expenditures that the company has been spending pretty much. It's like 11 billion, 15, 16, 14, 20. You'll see that this is on the increase here. And what about the dividends paid? 5 billion, 5.6 billion here. That was 2021. And so this keeps increasing, of course. And right now, being at $5.6 billion, with the company making, though, about 9.6, that is again 2021, with an insane amount of capital expenditures. So the previous years, the free cash flow was like 20 billion, 16 billion. So frankly, if we exclude these insane capital expenditures, which are not going to be happening every year, again, these capital expenditures will probably kind of subside after a couple of years or so. So they could go back to 10 billion, something of that sort, where they were over here, maybe even 15. But when that happens, this is going to be like, again, close to something like 20 billion here, which is about 1/4 of what the dividends paid is. So more than likely, it looks like they can still pay their dividends without much trouble here, and it's not really a company that has a lot of debt pretty much. They don't have a lot of cash at hand, but it's like a year of dividends pretty much, as you'll see here. About $55 billion is what they have at hand at the end of 2021, that is the fiscal year. So yeah, it's good to take this into account for potential, if you are potentially thinking to add this to your portfolio. We kind of want to examine all these, all these potential signs about the company and kind of, see whether it makes any sense to be buying this one. Now, what about the actual price to pay? Is this cheap enough? So, what kind of revenue growth are we going to use? You will see that last year they basically grew at 1.5%, and now it looks like things could be dire. So we could see a period where the company doesn't really grow, and maybe they even go negative. So what I will do here is I will go -2%, 0 and 2%. So this is probably something that won't happen. I don't expect the company to have like -2% for the next 5 years. This is more than likely not realistic. They will probably going to be positive. But I want to take the worst case scenario here, like -2%, 0%, basically not growing at all, and 2%. What's going to happen? The margins that I'm going to use are going to be less than these ones because we do know that they're getting suppressed. So I will go 18, 19, and 20. Kind of dire scenarios is what I'm using here. And the free cash flow margins, again, these are suppressed because of the capital expenditures, and it's something that we know about. Now, if we go back to 2020, you'll see it's about 100%, 80%, which is what makes the most sense. So I will go there, 80%, 90%, and 100%. So 80% would be something like 17% if you actually correlate free cash flow to revenue directly. And their annual return, 13% is what I ask for, typically. So what do we get out of this one? So out of this one, we get a low of 33, a medium of 43, and a high of 55, which makes a ton of sense, of course, because the stock price has been really, really suppressed. And right now, it's actually 27, remember, it's not even 30. So it's actually significantly less than this projection results even. And again, if you go back to our metrics tab, you can kind of see it already. The multiples of the company are very, very low here and getting lower. But we do have the concerns that I talked to you about. We have the dividends concerns, we have the concerns about the company's growth and net income. It looks like they could have a couple of quarters or even a year, this year, of potentially bad earnings or subpar earnings. But it could still be an opportunity to start adding a little bit to a portfolio and have it there in in a portfolio that's going to be lasting for many years to come. Again, this is probably not a great company to buy if you are a trader. More than likely, I think short term, this is probably going to be trading sideways or maybe kind of up a little bit and then down a little bit. More than likely, I don't anticipate crazy movements. But for a long-term holder and a long-term investor, I think this one is a company that should really more than likely deserve a place in a well-established portfolio that is seeking to make some good returns over the years and not like tomorrow. So thank you for watching. Leave a comment below. Tell me what you think about Intel. I'm very curious to hear what you think about this company and whether you are buying it or selling it right now. And remember to leave a like and subscribe. And as usual, if you want to gain access to our tool over here, any Patreon can. All the links in the description box below this video. And I'll see you soon. Bye-bye.